Hi, good afternoon, everyone, and welcome to LIBOR's Wednesday webinar. My name is Mary Ann Monteleone, Director of Education for LIBOR, and I'd like to welcome you all again to our Wednesday webinar today. We have a great program scheduled for you today and an amazing guest who took the time to be with us. And our topic is Staying Out of Trouble, How New York Realtors Can Avoid IRS Drama. So, before I introduce Heather, I just want to read her formal introduction so that I don't miss anything. Heather Liston is a certified financial planner, CFP, and an enrolled agent. She does fee-only financial planning through Hargrave Fiduciary Advisors and also prepares tax returns. Heather studied liberal arts at Princeton University and earned a master's in accounting at the New York University Graduate School of Business Administration and a certificate in personal financial planning from the University of California at Berkeley. She teaches financial planning courses, including income tax and retirement planning and accounting at UC Berkeley Extension. So today I'd like to give you an official welcome, Heather, to Long Island Board of Realtors Wednesday webinar, and I turn it over to you.
Thank you. I hope everyone can see my screen. It should be blue and orange, and it says Staying Out of Trouble, How New York Realtors Can Avoid IRS Drama. So that's what we're going to talk about today. I encourage you, if you have questions, put them in the Q&A, and we may interrupt along the way, or we may save some of those for the end. As much as possible, try to stick to the topic because we've got lots and lots to cover. So how to stay out of trouble is our main topic. And here we go. Okay, so first of all, an important disclaimer. I'm going to be talking about a lot of things today. Some of them are kind of technical. And you know how the IRS is, you think you understand it, and then you find out there's a loophole, or this applies to me, but not to her. So I want to make sure that you realize if you are applying anything you learned today to your own personal situation, do run it by your tax preparer, your financial advisor. Sometimes there are nuances. And so neither I nor Mary Ann or anybody at LIBOR can really specifically tell you personally what to do, but I'm hoping you'll learn some things you can apply. This is just one of my favorite cartoons from the New Yorker about the IRS falling during April showers. Okay, so most people probably are finished with their 2021 tax returns, although maybe not. You may have gotten an extension. And we're now into the time period where you want to make sure you're filing estimated taxes along the way. So here's the things we're going to talk about today as far as how to stay out of trouble. Audits and matching letters. I know you may not know that term. We're going to talk more about matching letters. One of the most important things I'm going to impart to you today is you always need to file your tax return, even if you can't afford to pay. Always file. Report everything. Understand that everything that can be matched will be. Again, I'll explain more later. Big issue, check your math. It turns out that a lot of the triggers for audits and a lot of what gets people in trouble is simple arithmetic errors, which is such a shame. It wastes so much of your life if you do that by mistake. We're going to talk about withholding appropriately, keeping your documentation, understanding your state. New York, of course, is particularly complicated. I'm currently in San Francisco, but I'm a former New Yorker. And those two states are certainly the most complicated when it comes to tax and financial issues. Lots of extra rules. We're going to understand business expenses. And if we have time, we're going to talk about basis, which is a big topic in its own. But basis is important for people in the real estate business in particular. Okay, common problems. What gets people in trouble with the IRS? Number one, unreported income. You have to report all of your income. RMD mistakes. RMD stands for required minimum distributions. That's not our main focus today because I think most of you are still working, and RMDs happen usually when you're 72 years old. But that does cause a lot of problems with taxes. Math and proofreading, underreporting, so not reporting something you should have, and taking inappropriate deductions. Now that's an issue that does apply to realtors because you get to deduct a lot of things, especially if you're self-employed. So we're going to look at what you can and can't deduct. Now, if you realize you made a mistake on your taxes, you file an amended return. That's one way to avoid drama. All right, this is information direct from the IRS. I recently attended a webinar with an IRS taxpayer advocate. And what they said to avoid trouble is file electronically. So when you fill out your tax return, you can mail it in. But if you mail it in, it's scrutinized more. It takes longer to get your refund. And the IRS doesn't like you as much. They're really encouraging us to do everything online these days. So file electronically. The IRS also says use direct deposit. So if you're getting a refund, there's a place in your tax software where you can say, please directly deposit my refund. That's faster than waiting for a check in the mail. They again reiterated, triple check all your figures. Don't make careless mistakes. That wastes a lot of everybody's time. Then they said, if you must file on paper for some reason, keep a copy. And they said, definitely pay extra when you go to the post office and get that return receipt requested. It would be a darn shame if you mailed in your tax return and it got lost in the mail in some way. So again, this is direct from the IRS. And then they say, if you file electronically and you have no errors, excuse me, refunds are typically paid in 21 days or 3 weeks. I have heard from some clients recently that their refunds are taking a really long time. And sometimes we don't know why, but you can go online. If you're waiting for your refund, type in, where's my refund? And you will get to an IRS site that might give you some more information. But just so you know, about 3 weeks is kind of the normal time frame. So don't bother anybody before 3 weeks. Okay, audits and other investigations. So again, we're trying to avoid drama. If you do get an audit, you can deal with it, you can manage it, but what we really want is not to get audited. But a little more about how this works. So this is information I got from a financial planning magazine, financialplanning.com, in 2018, but the trend has continued. The number of tax returns examined, as they say, by the IRS drops every year. So as of 2018, they were auditing 0.5%, 0.5%, which was more than 1 million people. That has continued to go down. It's less than 0.5% overall now, which is pretty good news for a lot of us. And also, I think it's interesting to know that not all audits end badly. So if you do get a notice you're being audited, don't panic. First of all, that's important for a lot of reasons. But one reason is it doesn't necessarily mean you did something wrong. When it comes to actual audits, very often it's random. There's a certain percentage every year that get picked at random. Or there may be a misunderstanding or something. And this is a notice that as of 2018, about 30,000 of the audits resulted in taxpayers getting additional refunds. And I've seen that happen in my own life. A friend of mine got audited about 2 years ago. It was a huge pain in the neck. She did have to spend a lot of time producing more documents, having a guy come to her house. It was very irritating. But at the end of it, he wrote her a check for $12. So she hadn't done anything wrong. She didn't owe extra money, but we really want to avoid audits no matter what. Now, so less than 1% of tax returns are selected based on, this is the discriminant inventory function system. This is that secret IRS system that knows which returns they want to audit. Nobody knows exactly what those triggers are. We have a few guesses, about what triggers, like extremely high income or taking a home office deduction that may be too high a percentage of your income. Few things like that, but nobody knows for sure. And again, some of them are at random. But so the number of actual audits has been going down, but what's been going up is letters. And so they're sometimes called correspondence audits or letter audits. And that's when you get an automated letter if your reporting documents don't match up. So one really common type is the CP 2000 letter. And some of you may have gotten a letter like that in the last year or two. It can feel very upsetting when you get that letter. None of us want to hear from the IRS, even me, and they send me, since I'm a tax professional, I get all kinds of ordinary helpful stuff in the mail. But still, every time I open my mailbox and there's something from the IRS, I wish there wasn't, right? We don't want to hear from them. But if you get a CP 2000 letter, or some other kind of official letter, there's other CP numbers, but this is a very common one. The first thing to do is don't panic. It's a 2 or 3 page letter. It will tell you what the issue is and what they want. And in many cases, the issue is that something didn't match up, that maybe Like you worked for an employer, they sent in your W-2 to the IRS that said you made $50,000. You said you made $40,000. The computer system is going to match that and say, ooh, there's a problem. Now, the problem might not be your fault. You know, maybe your employer made a mistake, but the computer system is going to notice that. So that's one of our really important points, that anything that can be matched will be matched. And if anything doesn't match up, you're going to hear from the IRS and you're going to need to explain it. So more information about what triggers audits and letters. So this green part here, field examination. This is the This is the number of returns that the IRS actually did a real audit for. That's what field examination means. That means somebody comes to your house, looks at all your documents, things like that. You want to avoid that. That's the real audit. So you'll notice that's a relatively small number of returns. That's the green part. It's a relatively large amount of money. Now, on the other hand, these two big blocks, the blue box, the light blue here is math error notices. Again, those are like the dumb mistakes. And this orange part is automated under reporter. So that means those are the ones where, you know, you said you earned $600, your 1099 says you earned $610. It's not a lot of money, but it doesn't match up. And it says automated because the computer checked that. Nobody like looked at it yet and said, oh, we understand why this happened. It's just a computer said, hey, these don't match exactly. You get a letter, you have to explain. So you'll notice that's a very large number. Those are the two biggest triggers for IRS problems, math errors and underreporting amounts, things that don't match up. Now, if you look over here, you'll see those do not result in the largest amounts of extra money owed to the IRS, but they trigger the most problems. So we want to avoid those problems. So math error notices, you'll notice here, this was fiscal year 2019. The IRS sent out over 2 million notices, almost 2.2 million notices to people who just made math errors. Now, if you're using software, which you probably are, or you're hiring a tax professional, these math errors should be minimized. Much more likely to happen back when I was your age and we did things on paper. But in any case, you still have to be careful, proofread everything, have somebody else proofread it. Just don't get caught up in dumb mistakes. Okay, now these are more statistics from Financial Planning Magazine. What I highlighted in red here is the fact that you might actually be a little more subject to audit than other people. So the overall audit rate was not very high. As we saw, it was less than 0.5% that year. But sole proprietors, those are business owners who have gross income between 100,000 and 200,000, much higher percentage of those people get audited. And I realize that a lot of you may fall into that category. I know that you're usually often self-employed. And at this point, that's a pretty reasonable annual income. You know, sometimes these ranges are set a long time ago, like the IRS will say, oh, let's look at X% of people who make over $100,000. That used to be a very high income. It's really not such a high income right now. And sometimes they don't adjust their categories fast enough. So I just want to point out, you may be a little more subject to audit than the general public. Okay, so in the IRS CP 2000 program, that's those letters that come out when things don't match up. The IRS matches income between tax returns and IRS information to look for discrepancies. And if there's a mismatch, the IRS automatically sends out a notice asking for an explanation. This keeps going up. They're doing more and more of that. So their computers are doing a lot of the work for them. They're not having a person look at these initially. It's just the computer says, oops, there's a problem. You get a letter. Even if it's not a real problem, you get a letter, you have to explain more. So your chance of that is 1 in 35 as of 3 years ago, and it keeps going up. All right, we'll talk more about what to do about those letters soon, but this is a really important issue I want to bring up, which is you always should file a tax return. And I have talked to some people, some clients who say, oh, I didn't file for 3 years. And sometimes you get in a shame spiral, not you, but some people. They think, oh no, I didn't file last year. I'm going to hide. I can't face this. I don't know what to do. So either I got so far behind, I'm embarrassed, I don't want to catch up now, or I can't afford to pay. I somehow spend all the money I earned this year. I don't have enough money to pay, so I'm not going to file my tax return. Don't not do it for either of those reasons, okay? So penalties for not filing your tax return are 5% of what you owed per month that you don't file. Penalties for not paying what you owe are 0.5% per month. In other words, it's much more expensive to not file than to not pay. I know it's embarrassing and upsetting if you can't come up with the cash to pay your taxes. But again, the IRS will work with you if it's a money problem. If it's a not filing problem, you need to get busy and get it done. They are less sympathetic about not filing. In other words, they kind of forgive you if you're broke. They don't forgive you so much if you're lazy. So get it done. So interest and penalties. If you make a mistake on your tax return, the penalty for an accuracy related penalty, like I added things up wrong, is 20% of what you should have paid. The penalty for fraud is 75%. Now, I know that you would not deliberately commit fraud, and deliberation is one of the definitions of fraud. In other words, if it's something related to fraud, it usually means you did it on purpose, but you don't want anybody even to think you did something on purpose. And then in addition to penalties, you may be charged interest. The interest rate varies. It's hard for me to say exactly what it is because it's partly tied to the LIBOR interest rate. I know that's another term for you, but in other words, it's partly tied to general interest rates. And then there's a percentage on top of that. So it's often around 4%, but it's probably going up right now as inflation goes up. So in other words, if you get behind on paying your taxes, you're going to have penalties and you're going to have interest. Okay, reasons to file your tax return, even if you can't afford to pay. First of all, there's no statute of limitations on auditing you if you have not filed your tax return. There is a statute of limitations if you filed on time and did everything you could. In those cases, it's likely that after, depending on what the issue is, after 3 years or 4 years or 6 years, the IRS may not be able to audit you anymore. But if you haven't filed a return, no statute of limitations. They can ask questions as long as they want if you haven't filed. Number two, if you haven't filed your tax return and you want to file for Social Security or Medicare or unemployment, the first thing that agency is going to say to you is you got to catch up filing your tax returns. This has come up for me lately. A couple of people have contacted me and said, oh, I got behind on filing, but now I'm trying to get Social Security or unemployment. Can you help me catch up the last 3 years? So again, keep up, because all government agencies talk to their computers talk to each other. If you're thinking to yourself, they'll never figure it out, the government's inefficient, you're partly right, but their computers have gotten very efficient. And so the Social Security Administration does know you haven't filed your tax returns. Okay, another reason to file a tax return, if it's a money issue and you're not filing because you're worried you can't afford to pay what you owe, the IRS will work with you on an installment plan, but they won't work with you unless you've caught up all your required tax returns for the past 6 years. So you've got to be caught up on that paperwork. All right. If it's a timing issue, and this is common, by the way, for self-employed people too, maybe April 15th comes around, but you haven't received all your 1099s yet. The people that you worked for are behind. Or you're trying to gather your business expenses and you're waiting for some information. That's okay. Don't panic if it's April 15th and you haven't got all your information. File an extension by April 15th. If you file for an extension, which is very easy to do, or you tell your tax preparer, I'm going to need an extension, get that done by April 15th, and then you almost certainly will have an automatic extension until October 15th. So you buy 6 months of time very easily for filing. Now, one important thing to know is you still have to pay on time. So in other words, let's say I know it's April 15th is coming up. I haven't gathered all my expenses yet. I'm not ready to file. But if I'm self-employed, chances are I had a fair amount of income during the year and I do owe taxes. Make an estimate of how much you're going to owe and pay that by April 15th. Of course, you don't know the exact amount because you haven't finished your tax return. But if you get an extension and you owe money, you are going to be accruing interest on the unpaid amount between April and October. So make an estimate and pay on time, file your extension on time by April 15th, and you'll be fine. You have an extra 6 months to do that work. Now, if you filed for an extension, 2 bits of recommendation. One is don't be late after October 15th. That extra 6 months is enough time to gather all your data, get all your K1s and 1099s. It is enough time. So definitely meet the October 15th deadline. Another important point is, especially if you're working with a tax professional, don't just wait till October 15th. And I'm a little frustrated myself because I filed about 4 or 5 extensions for clients this year. But I said to them, okay, I understand you're not ready by April 15th, but I'm going on vacation in June. I want all this done before that. So I said, please send me everything by May 31st. They all promised that they would. I haven't heard from one of them since. I think it, sometimes when people file for an extension, they think, whew, I don't have to think about this till October. Don't do that. If you file for an extension, yes, you buy that extra time, but your tax person doesn't have time to do everybody's taxes on October 15th any more than she had time to do everybody's on April 15th. So if you need an extension, gather your information as soon as you can. Get your taxes done in May or June. Don't wait till September or October. Okay, that's my little preaching. All right. So that was the deal about extensions and filing on time. Next issue is report everything. A little history on this. I see a question popped up in Q&A. Should an agent who is not registered as a business owner file a joint with spouse? I'm not quite sure what you mean by registered as a business owner, but I'm going to answer that question more generally, which is, it is almost always wise if you are married to file as married filing jointly. It is very rare that you're better off married filing separately. So if you are married, you almost certainly want to file jointly. There are lots and lots of reasons why it's better to file jointly. And because that's not our main topic today, we can't go into too much of that, but that's my first response, is probably file jointly. If there's particularly tricky issues about it, talk to a professional about your tricky issues, but almost always file jointly if you can. Okay, and by the way, go ahead and do put questions in Q&A if you want. Since we haven't been deluged, we can probably handle them along the way. Otherwise, we'll save them for the end. Okay, report everything. So a little history on that. When income taxes started in the US, which was early 20th century, the 16th Amendment to the Constitution said, the Congress shall have power to lay and collect taxes on incomes, and I highlighted, from whatever source derived. So they didn't say you just pay income tax on your commissions or you just pay income tax on your rental income. They said from everything, unless we say otherwise, basically. So here's a little more definition of what they meant by everything. But basically, they mean everything unless we say otherwise. There are a few things that the IRS law specifically says are excluded. Like, you're probably familiar with the fact that if you sell your primary home at a large capital gain, the first $250,000 does not count as income, or the first $500,000 of gains if you're married. So that is specifically excluded in the tax code. But anything they don't specifically exclude, you should assume is included. So in other words, you have to include all your W-2 income from your regular day job if you have one, all of your 1099 income, all money you earn, even if someone doesn't send you a 1099. I get this question a lot, like, hey, I did some work for this guy, or I sold a house and I made $10,000, but the people didn't send me a 1099. Do I have to report that? The answer is yes. If the person you worked for didn't send a 1099 and they should have, that's kind of their problem. They might get in trouble because they should have sent it and they didn't. But don't make that your problem. You know how much money you earned. And so you have to report it even if they neglected their part and didn't send you the 1099. Feel free to call them up and push them and say, hey, I really need that 1099 because I need to make sure that I report exactly what you report. But if that person is unresponsive, not your problem. You have to file correctly how much money you made. Okay. All of your net business income, you have to report all of your interest and dividends, any realized capital gains, any income you earned from renting real estate, any income from selling real estate, except the specific exclusion we mentioned, any royalties, basically include all of your realized income. Okay, next big issue, matching. We've alluded to this a couple of times already, that the IRS is largely staffed by computers these days. They are very understaffed with people. So things that require people are going to take time, but their computers seem to be working fine. So anything that can be matched will be matched. So if you get a W-2, for example, and it says you earned $6,000 this year, the IRS already knows that. That employer sent a copy of that W-2 to the IRS. Their computer knows you earned $6,000, or that at least that somebody says you did, and they're just waiting to match it up. So do not say you earned $5,999, even if you think you're right. If you really think the W-2 is wrong, call your employer and say, hey, you made a mistake on that W-2. You need to issue a corrected W-2. But don't just think, oh, the IRS will be fine with what I say. They're going to match it. You're going to hear from them if it doesn't match. So W-2s, 1099-B, that's the form you get from your broker showing how much you made on your investments. 1099-R shows how much you withdrew from retirement accounts. 1099-NEC, that's a new term for non-employee compensation. So, money that you earned doing things that is not through a W-2. 1099-DIV, that's dividends, interest income. K-1s for business owners sometimes. IRS already has that information. They know if you sold stock, they know if you worked for a company, they know if you won the lottery. So it's hard to keep secrets for them. They're gonna match it. Okay. And before we jump into this topic, I think a couple more questions popped in. Okay. They weren't really questions. So good. Do go ahead and keep posting questions. All right. Keep your documentation. This is a really important part of, first of all, reporting things right in the first place. Second of all, staying out of trouble if you do hear from the IRS and you do need to prove anything. So you need to keep your documentation. And what does documentation mean? By the way, this is especially important for self-employed people. You probably have lots of documentation. Receipts for things that you buy, invoices for things that you buy or things that you sell or whatever, invoices, real estate closing documents, credit card statements. And these things are really important, receipts and invoices, especially the first three. But if you don't have those things, these things can help. Diaries, logs, and witnesses. For example, if you went to, let's say you're building a house, you went to the lumber yard one day, you bought X dollars worth of lumber to put an addition on the porch of your rental property or something. If it's a rental property, that's a business expense. That lumber you bought is deductible, but maybe somehow the receipt got lost, the lumber yard burned down, you can't track this down. But if you kept notes that day and you wrote down that same day, I bought 6 tons of lumber. I don't know how lumber is delineated. I paid $7,000. If you wrote that down at the time, it's better than nothing if you ever have to prove it. Witnesses, I think of that particularly when it comes to things like business meals. Again, keep your receipt. If you take someone out for a business meal and you think it's going to be deductible, keep your receipt and jot some notes on it. Okay. The receipt will probably say lunch at El Piazzo restaurant, $65. But what I want you to jot on it, on that paper receipt, is took Dave out to lunch to discuss the new deal on such and such a property. Jot that down. Maybe I was going to say circle his meal. That's not necessarily important. At this point, you probably can deduct the whole bill, but jot down what you talked about, where you were, what time it was. And again, if by some chance that receipt gets lost and you can't reproduce it, if your assistant was with you and she's willing to swear to the IRS under oath, yeah, Heather really did take Dave out to lunch and they really did talk about this. Again, that's better than nothing. But real receipts and invoices and notes are really important. Okay, so how do you track it? Sometimes people who are great business owners, who are really creative, great salespeople, sometimes they're not that organized. If your business is growing large and you know that organization and details are not your strong point, I hope at some point you can hire somebody, an assistant who can manage all the details. But until that point, there are lots of ways to track things. You can do it in Excel spreadsheets. There are lots of apps for it. You can certainly keep track of physical stuff if you want to. Like these days, I tend to, when I go to a restaurant or something, I click the button that says email me my receipt, and then I save it on my computer. But in olden times, like 3 weeks ago, I used to bring home the paper receipt and put it in a file folder. That's fine too. Either way is fine. If it's easier for you to keep track of paper, put it in files or put it in shoe boxes. You know, if you've got a load of paper, put it in a shoe box for saying business expenses. And at the end of the year, sort it all out if that works for you. You know, if you like keeping track along the way, do it. If you don't, at least keep all the paper so that somebody can sort it out at some point. If you don't have the space or you don't like paper, scan your receipts, keep them on your computer in virtual file folders. So in other words, all these methods are valid. Find something that works for you. Don't freak out about which method, but make sure that you have some method. Now, I have a sister who's a realtor. So I asked her a few months ago, Like, what's the best way to keep track of all those business expenses? She's a realtor. She's also an appraiser. And so she's been self-employed for a long time and she has to keep track of everything. She did a poll among her peers and found that these were the things they liked best. Mile IQ. Personally, I'm not familiar with that, but I think it's specifically for keeping track of your business mileage, which is super important. A lot of you may be able to deduct car expenses, and that can be very valuable. So Mile IQ, QuickBooks app, or a program called QuickBooks Self-Employed. Personally, I keep track of my things in Quicken. That's made more for personal expenses than for business expenses, but I find it works great for me. I've been using Quicken for more than 20 years. These are mostly apps, TripLog, Modus, TaxBot, Mileage, Ace, Excel on a phone, Driver's Note. So if you haven't already heard of these, you might want to look into them. Or if you have a good system that's working for you, that's fine too. The main point here is the exact system doesn't matter. What matters is that you do keep track. All right, stay organized. Yeah, whatever method you need. All right, keeping your records. People always ask, how long do I have to keep this stuff? And a lot of people just have this idea in their mind of 7 years. And I remember when I was a little kid, my father would pull out his canceled checks. He would keep them in a box because everything was on paper back then. And at the end of each 7-year batch, he'd destroy the checks. That's not really the correct answer. Maybe it was at some point, but 7 years is not a magic number at this point. There are various statutes of limitations. So the IRS has 3 years from the time of your filing date to audit your return if it suspects good faith errors. That means you made a mistake, but you didn't mean to. If they think you have underreported your income by more than 25%, they have 6 years to audit you. If they suspect fraud, or if you haven't filed your returns, then there's no statute of limitations. In either of those court cases, they can ask you questions forever. So I know that I would never commit fraud, but I don't know for sure that nobody would ever imagine that I did. So I try to keep important tax documents forever. Now, I live in an apartment. I don't have the space to keep everything on paper. So what I do is when things get older, let's say more than, honestly, I keep a lot of paper, but what would be legit is after 6 years, scan the important stuff. Keep it on, on some kind of a disk somewhere if you don't have the space for the paper. But I really do think when it comes to important tax documents, it's good to keep them in some form forever because you never know. But for at least 6 years, okay? Keep all the important documentation at least 6 years. Now, another important thing is that sometimes states have different rules. In New York, it's usually 3 years, sometimes 6 years. And so in other words, New York is kind of lined up with the federal government, which is good to know. If you do business in other states, though, be aware that some of them have longer statutes of limitations for no apparent reason. Okay, so what? So keep your tax records, keep your entire file of tax stuff with all your receipts for at least 3 years, 6 if possible. If you have any doubts or worries, keep stuff lit longer. And if possible, scan your old returns and save electronic copies. I'm going to peek at the questions again before we go on to withholding. Okay. So this question that I got, it's an important question, but it's a little beyond the scope of today. So I'll go ahead and read it to you, and then I'll suggest that maybe we should do a whole topic on this. The person says, do you recommend treating all of your real estate investment as one single activity if you are qualified for REPS? That means real estate professional status, and actively participate in management over anyone else. And what's the downside if you treat it as one activity? Sorry, that's kind of not in our scope today. It is an important topic. And one thing that you may or may not all be aware of is the IRS has this terminology called real estate professional. And I know chances are you are a real estate professional, at least in the generic definition, if you're here today at all. But the IRS has specific criteria that make you fit into their definition of a real estate professional. And things are handled a little differently in that situation. So I'm sorry, sir, your specific question, it's a little beyond today's scope, but it is important. So I'm going to avoid trying to jump in without more information. Okay, withholding appropriately. So if you have a regular job with a W-2, your employer will probably be withholding taxes, which is helpful. If you do not have a regular job with a W-2, you're going to need to pay estimated taxes if you earn money. And in either case, you want to get as close as you can to what you're going to owe at the end of the year. So here's how to avoid penalties. You will not pay penalties for under withholding if you've paid in at least 90% of what you're going to owe for the current year. That's what CY stands for. Or 100% of your total tax liability for the prior year. Or if you're kind of a high income person who earned more than $150,000 last year, withhold 110% of your total tax liability for the prior year. These, again, are ways to avoid penalties. They don't guarantee that at the end of the year, you're not going to need to settle up. They don't guarantee you will pay exactly the right amount for the current year, but you're going to avoid penalties for underpayment. So, and what that means is 90 or 100 or 110% of your total tax. People get confused by that sometimes. They look at this and they say, well, 100% of what I owed last year. Oh, at the end of last year, I only had to pay $30 because I'd paid in along the way. No, it means 100% of last year's total tax bill. So look to find out what that is. You look at your tax return, and for 2020 and 2021, your total tax appeared on Form 1040, line 24. Notice it says this is your total tax. What we're not talking about is the amount you settled up at the end of the year. All right. In most cases, you have to pay estimated taxes if you expect to owe a total of at least $1,000. And if you're working at all, you probably are going to owe at least $1,000. Or if you suspect your withholding and refundable credits to be less than one of those, less than 90% of the current year or 100% of last year. Now, how should you manage your estimated taxes? The answer is if you have the opportunity for withholding, do it that way. So maybe you're self-employed part-time, you sell some real estate, but you also work either part-time or full-time in a day job with the W-2, or let's say maybe you're fully self-employed, but you have a spouse with a day job. I'm hoping, again, if you have a spouse that you're filing jointly, it's almost always the right thing to do. And if that's the case, if you are filing jointly, you can withhold from either person. So if you have a real estate business, you're self-employed, you have a husband or a wife with a day job, talk about it together. Remember that the IRS sees you as a unit, as does New York State. You can have more withheld from that W-2 spouse's job to cover the tax for both of you. It means that person with the day job is going to be bringing home less, and that might be painful for them that they're having more withhold, less take-home pay. But you as a couple will be better off that way if you have it withheld instead of you having paid estimated taxes. Now, why is it better to do it through withholding than through estimated taxes if you have that opportunity? Two reasons. One is it's easier. Paying estimated taxes is a little bit of a pain in the neck. You have to remember to do it. You have to figure it out each quarter, et cetera. The other reason is withholding is presumed to have been received evenly throughout the year. So for example, let's say you have a business, you haven't paid enough in estimated taxes during the year. You're getting near the end of the year, you realize you messed up and you're going to owe a lot of tax because you should have had money withheld. You should have paid estimated tax in April and June and September. You forgot, or you withheld too little or whatever. If you could doing it through withholding, you can have a big chunk withheld the last couple of months of the year, and the IRS treats it like it was withheld all year. So in other words, if you have a day job with a W-2, you can sort of bunch it up and have a lot of withholding done at the last minute at the end of the year. If you're solely paying estimated taxes, you're supposed to do it at the right time throughout the year as you're earning that money. So how do you even know how much that is? Okay, the IRS has a pretty good withholding calculator. If you did this years ago, you will immediately dismiss me and say, no, that calculator's no help at all. They improved it a couple of years ago, about 2 years ago, they made it better. So if you haven't tried it for a while, go to this, if you don't have this link, just Google it, IRS withholding calculator. It will help you figure out how much to have withheld throughout the year. And it will ask you questions, not just, old W-4s used to just say, are you single or married? And you didn't have to tell the truth, that was confusing. And how many children do you have? Those two questions alone do not answer how much should you have withheld. So W-4s have gotten better and the withholding calculator has gotten better. It will ask you more questions like how much investment income do you have? Do you have a spouse? Does that person have a job? How much business income do you earn? It will help you figure out a rational amount to have withheld. Payment due dates. We sometimes refer to estimated taxes as quarterly taxes. It's not exactly quarterly. You'll notice the due dates are April 18th, June 15th. That's 2 months later, not 3 months later. September 15th, that's 3 months, and January of the following year. So not exactly quarterly, but these are your due dates. Now, one lucky thing about New York State, again, is they line up with the federal government. I'm in California. We do not line up. We pay weirdly throughout the year and nothing in September. You don't have to worry about that. You are supposed to pay 25% of what you're going to owe for the year here, 25% by June, 25% by September, 25% by January of the following year. There are some nuances about due dates in special situations. If you think something complicated might apply to you, we don't have time to go into that today, but you can always look up more information about estimated taxes. There's an IRS publication devoted to just that. But in general, these are your due dates. Let's see, to pay. Paying online is better. If you don't mind paying online, the IRS prefers it, and so does New York State. So for your IRS payments, you're going to go to irs.gov/payments. You're going to enter the information. For New York State, here's your link. Again, you can probably find it just by Googling New York State estimated taxes. You can pay online. They'll help you figure it out. If you use a credit card online, they're going to charge you kind of a hefty fee. If you have it direct debited from your bank, which they prefer, both the IRS and New York State prefer that, no extra charge. You can also mail in your payment with a voucher. Again, they prefer and they'll process it faster if you do it through direct deposit, but if you prefer the mail, go ahead, it's fine. And more information, of course, on the websites. So to keep track of your estimated payments, that's important. I've run into this quite a bit the last year or so, where I have some clients who earn huge amounts of investment income. This is California. We've got some people earning lots and lots of money through their investments. They do pay estimated taxes. They do have enough money, but they get incredibly confused. It's a husband and wife. They can't remember how much they paid. They don't know when they paid. They pay it sometimes through her account, sometimes through his account, which is perfectly legal, but the IRS tracks it by Social Security number. So I've asked them, please start paying all of your family estimated taxes through one account so that when I look at your IRS account, I'll see it all in one place. So that's one of my pro tips is if you're married, have one spouse make your estimated payments so they're all in one place on the IRS website. It's easier, again, it's easier to track if you pay online, but also keep track of the dates that you paid and the amounts that you paid. Know which year your payment was for. Like your fourth estimated payment for 2022 is due in January of 2023. Sometimes that really confuses people and they think, oh, I paid it in 2023. I guess that's for 2023. No, that's for 2022. So it's confusing, but do whatever it takes so that you keep track. You know what you paid, you know when you paid it, and you know what year you meant to apply it to. All right, next question. And we're getting a little low on time, so I'm going to rush through this part a little bit. The state that you live in for tax purposes is really important, and the rules are a little bit vague, which is weird. Now, if you live in New York State and you work in New York State, might not be that complicated. Where it got confusing recently was during the pandemic, lots of people kind of moved to another place temporarily. So if, let's say, your main home is in New York, maybe you own a home in New York, you've always filed in New York, you work in New York, but during the pandemic, maybe you said, you know what, I don't have to be here. I'm going to go to my vacation home in Florida for 6 months. That's fine. You're welcome to go there, but your domicile is still New York. New York will still expect you to pay full New York State taxes. So that's kind of the main point I meant to make here is that temporary relocations don't count. Be sure that you know where is really your home. And again, we won't go into all the details about how to prove your home because I think you're probably more interested in business expenses. Because especially if you're self-employed and especially if you're in real estate, your business expenses probably are deductible. So it's incredibly valuable. And of course, there are lots and lots of rules. So I want to focus on just a few. Basically, if you are self-employed, all your legitimate business expenses are deductible. If you are not self-employed, if you work for another company and you get a W-2, your business expenses are not tax deductible. They used to be, so this confuses people, used to be that even if you were an employee of a company and you got a W-2, any work-related expenses were deductible. But starting in 2018, that's not true. They're still completely deductible if you're self-employed. They are not deductible if you work for another company. But if you are self-employed, as I know a lot of you are, very valuable, and I want you to take the maximum possible business expenses. So we will quickly go through what those are. And since our subject is staying out of trouble, we'll try to note the places where they're not deductible. So first of all, business expenses, if you are self-employed, are still fully deductible. Your business expenses go on Schedule C, that's for self-employed people. Rental real estate expenses usually go on Schedule E, and neither of those has anything to do with personal deductions, which go on Schedule A. The reason I mention this is another area of confusion that I see a lot in real life is sometimes people say to me, oh, I'm not itemizing this year, so I'm not keeping track of my business expenses. Itemizing your expenses refers only to Schedule A. Those are certain very specific personal expenses, high medical expenses, your mortgage interest on your personal home, the taxes that you pay, and your charitable contributions. Those things go on Schedule A. And if you take the standard deduction, you don't get to deduct those. But they have nothing to do with your business expenses. So you might be taking the standard deduction, as most people do now. Most people take the standard deduction, don't file Schedule A, but you still, if you're self-employed, you take the standard deduction for personal stuff, you still get to fully deduct your business expenses. So I hope that is not confusing anyone, because that's important. Okay, employee business expenses, not deductible right now. Hobby expenses used to be deductible, not deductible right now. So if you've got a side business, whether it's real estate or basket weaving or any Etsy stuff, treat it seriously. Make sure you act like it's a business, not a hobby. Okay, 3 things that raise the most questions in my practice when people are self-employed: automobiles, home office, and meals and entertainment. For you people in particular, as realtors, I bet you use your car a lot for business, and I bet you have a nice car. My realtor friends all drive beautiful cars, and they take good care of them for obvious reasons. So the rules are, if you're self-employed or own a business, you're allowed to take a deduction for the business use of your vehicle. But if you claim you use it 100% of the time for business, be sure that's true. That can trigger suspicion, because it's much more common that someone owns a nice car, uses it for business part-time, but also uses it to pick up her kids from school, or to take his friends on a fishing trip or whatever. If you use your car only partly for business, keep track of your mileage for business. You're going to need to answer those questions on your tax form. All of your business miles are fully deductible. And this is somewhat good news. You've probably noticed inflation is scary right now, and in particular, gas prices are awful right now. I paid over $7 a gallon last time in San Francisco, if that makes you feel better about your prices, which I know are awful as well. So that's too bad. Those things have gotten very expensive. The IRS has responded, though, in a positive way. So right now, every business mile you drive, you get to deduct 58.5 cents per mile. As of July 1, for the last 6 months of the year, they just raised that allowance to the highest it's ever been in history. So for the last 6 months of 2022, you can deduct 62.5 cents for every business mile that you drive. That means business miles are a really valuable deduction. So absolutely keep track. And I also suggest that you take that standard mileage deduction. You have a choice as a business owner. You can figure out the exact amount you spend on your car. You can figure out how much you bought your car for. You can figure the depreciation, which is a little complicated. If you don't have a tax professional, you can save every single gas receipt, every single oil change receipt, all your tire rotations, and keep track of the actual expenses. That is a pain in the neck, and it's a lot of work. The easier way is keep track of your business miles, take the standard mileage rate deduction. It's very lucrative. I think you'll do better that way financially. It's also much easier. So that's a plea to do the standard mileage rate. Okay, 62.5 cents per mile. Also, if you take that standard mileage rate, you can still deduct parking and tolls that you drive for business. So do keep your receipts from tolls, even if you're doing the standard mileage rate. And do keep receipts if you pay for parking for business engagements. Okay, home office deduction, super important, super lucrative. Self-employed people, if they have a home office, they can take a deduction. Now, I certainly know people who say, oh, I work at home, but I don't take the deduction because I understand it could trigger audits. That is true. It can trigger audits. If you're super afraid of getting audited, maybe don't do it. However, I'm not afraid. I work at home. I have a legitimate business and I save a lot of money by taking the home office deduction. So my recommendation is know the rules, follow the rules, and if you have a right to it, do it. So what are the rules? This is for business owners only. If you work for another company and you get a W-2, you cannot deduct your home office anymore. You used to be able to, but now you cannot. This has been confusing for people, again, with the pandemic, because lots of people had a regular job. They still have that job. Their employer said, we need you to work at home now. You can't come to the office anymore. But guess what? Your home space is not deductible if you have a regular employer. It's not fair. It doesn't seem right. Nobody foresaw the pandemic when these rules were written. But basically, the rule is still, if you have an employer, you cannot deduct your home office. If you own a business, you can deduct your home office. Okay, the major two rules are the space that you deduct as a home office, you must use it regularly and exclusively for business, and it should be the principal place of your business. So if you have the easiest way is if you have a garage or a shed or something at home that's a whole separate structure. That's the easiest way. Second easiest is if you have a room, like maybe you've got a den or a family room or a closet that you think this is only for business. I never serve the neighbor's tea in here. I never watch TV in here. I use this only for business. That's important. It must be exclusive. Now, it doesn't have to be a separate room. You could designate a corner, but again, follow the rules and don't do other things in that corner. Use it only for business. Okay, more details here. If you have any questions about the home office deduction, I won't try to read you everything, but if you have any questions about whether you're following all the rules, get the IRS publication on home offices and check. Two exceptions to that exclusivity rule. One is if you're storing inventory in a closet and you also hang your out of season furs in that closet, that's okay. That's an exception to that exclusive. You can use your closet inventory storage for other purposes and deduct a portion of it, or daycare. Let's say you're running a daycare center out of your family room and at night, all those stranger kids are gone and your kids play in that room. That's okay. Daycare, it does not have to be exclusive space. All right, you get to deduct your home office expenses if you legitimately meet all the rules for a home office. Direct home office expenses would be if you paint or carpet the room you work in, or you build a new thing exclusively for business. Indirect would be a portion of your rent or a portion of your mortgage interest and property taxes and a percentage of your utilities. So for example, let's say you own your house, your mortgage interest is, X dollars, and your home office is 10% of that house. You're going to be able to deduct 10% of that interest, 10% of your rental payments. So you're going to check your square footage of your office. I'm going to peek at questions again. Okay, so one question is, would a bank statement be a good proof of expenses? Probably not. Your bank statement might show, that you wrote a check for $10. It won't necessarily prove where it went to. So that falls into the category of better than nothing. Do keep your bank statements, online or something, or make sure you have access to them. But don't count on that as good enough. Try to keep your receipts as well. Someone also brings up the issue about S Corps, subchapter S Corps, and whether you're an employee of that. So I'm sorry, but I'm going to also say that's a little beyond our scope today because we're already short on time. S Corps can be complicated. They can be a really good way to do this. S Corps can be a good way to organize your business, but if you're doing that, I would say speak to your personal financial advisor or your lawyer because they don't have time to go into exactly how S Corps are affected by business expenses. Okay, we're short on time now. So one thing about home office, if you are questioned by the IRS, clean up your space, make sure it's clear that it's a dedicated office, be very serious that you are in fact in business, and of course have all your receipts. Quick thing about business meals and entertainment. Also, this is for self-employed people only. If you have a regular job, you cannot deduct your business meals. One important thing about business meals, the IRS rules are changing constantly. They keep changing. Very recently, they gave us back 100% deduction for business meals, which is great, but you got to meet the conditions. The food and beverage costs qualify. You have to have a meal in a restaurant. So like if I invite someone over to talk business, but I make them dinner at home and buy groceries, nope, not deductible. Or if I get takeout and I have DoorDash bring something to my home office meeting, not deductible. But if I take a client to a restaurant and I pay for it and we eat the meal in the restaurant and it's not crazy expensive and it's in 2021 or 2022, I can deduct the whole meal. So that's nice. That used to be 50%. Now it's 100%. It's to encourage us to, to go to restaurants. So that's all good. But just one caveat, be careful. These rules do change. And of course, keep track as always. Not deductible business entertainment used to be that some business entertainment was deductible. Now it's not. If you take a client to the football game, that's nice. You might be able to deduct the hot dog you buy them at the football game. You cannot deduct the tickets. You can't deduct the cost of your transportation to the restaurant. If you join a country club so you can take clients to dinner, nope, the dinner might be deductible. The membership is not. Okay. Keep a written record, of course. All right. And I mentioned at the beginning that basis is a complicated question that issue that we might not get to. In fact, we have gone 55 minutes now. So if you're here for your continuing ed, you've met that requirement. I'm not going to read you all the information about basis. Maybe just keep in mind that, of course, basis is important. So here's my summary. If you get a letter from the IRS, read it carefully. Don't panic. Maybe for 24 hours, you can feel depressed. Oh no, a letter from the IRS, and set it aside. But then don't panic. Pick up that letter, force yourself to read it. It's only 2 or 3 pages. Follow the instructions. Very often a client will call me and say, oh no, I got a letter. I don't know what to do. The letter tells you what to do. It makes you feel like it doesn't, but it does, just because you're scared usually. And that goes for me too. I hate getting letters. But read it carefully. It will tell you what to do. The instructions will be there. If you realize, oh yeah, I did make a mistake. I did forget to report that income. Apologize, pay the difference. Don't do it again. That will keep you out of trouble. Just get it over with. If you don't think it was your mistake, there is a phone number on that letter. It says, if you need more time, call this number and ask for more time. So if you think that in fact, it's not your problem, or you can solve it, or you can answer it, it's not your fault, call that number immediately and ask for more time, and then gather your documentation and follow the instructions on the letter about how to appeal it or what additional information they need. So in general, file on time, be honest, answer questions promptly and accurately, tell your tax preparer everything. From time to time, I fire a client. I decide I'm not going to work with a client again. The answer is always dishonesty. I don't care how complicated their taxes are, and I don't care, how far behind they are. I'm willing to work with honest people through any problems. But if I find out a client is not telling me the truth about something or withholding information from me, that's too risky for both of us, and it's not worth it. So tell your tax preparer everything. If you don't understand something, ask. If you need more time, ask for it. Again, the IRS is understanding if you need more time. They're not understanding if you ghost them and you don't do things at all. Avoid fear, shame, and paralysis. They just waste your time. Again, you get 24 hours to panic when you get a letter. After that, don't just shove it under the bed and panic. Open it up, read it, deal with the situation. If you've got a problem, face it and work it out quickly. Always file. Remember, a computer can catch anything a computer can catch, it will. Don't go down because of a silly error. So in addition to math errors, I've seen people make a typo in their social security number. Huge waste of time, causes lots of trouble, and it's avoidable. Proofread, have somebody else proofread. Okay, I'm going to look at the last remaining questions coming in from you, but just in summary, thank you. It was really nice to sort of meet you. It's nice to be here. This is my contact information, hcliston@gmail.com. I would have a more professional address, but I'm in the process of changing compliance companies. So if you're wondering, this lady says she knows what she's talking about and she has a Gmail address, that's why. I'll have a better one very soon. Okay. I see Marianne popped back in. Do we have time to look at a few questions?
We do. And I just want to tell everyone, good news is this was hugely successful and we're going to have Heather back again. I wanted to make everyone aware that this is not approved for continuing education because it's a webinar. We would have to have a different setup and structure. So just want to be clear about that. But
Sorry,
yeah,
my mistake. I thought it was. Okay.
yeah, that's okay. Yes, we do have time for a few questions. Do you want to take them?
Sure. Yeah, I see a couple here. So somebody says, is there an all-encompassing document that gives a full list of allowable deductions for real estate brokers? Not exactly, but there are, I would say two things. There are documents that, there are IRS brochures that explain deductions for business owners. And a real estate broker who owns a business, of course, is a business owner. So that's important. So look up that one. And there is one particular document that's all about real estate ownership, but it focuses a lot on your primary residence as well as rental properties and things. I don't off the top of my head remember the names of those two, or the numbers of those two publications, but a very quick Google would get them for you. So what I would do is Google IRS instructions, real estate, and IRS instructions, small business, and you will find the exact rules for all those kinds of specific issues. A couple of tips about that. The IRS website is in general very good. I love to tell people that because I think a lot of us have relatively low expectations from government agencies. The IRS hires good writers. So if you go to irs.gov, many things will be very clearly spelled out, which I really appreciate. It is a useful source and it's the final source. You know, if somebody tells you something and the IRS says otherwise, the IRS wins. So do use irs.gov. I find the search capability isn't that great on that site. So like if I have a specific question, I don't search irs.gov. What I do is I look for the right publication. I Google like IRS publication or instructions for medical expenses. That one, by the way, is number 502, or IRS publication for real estate. And I get that publication, but it is good. Somebody says, what about your rent if you are living in daycare? Okay, I think that person means like if you're running a daycare business, because I mentioned that is an exception to the exclusive use of a home office. So let's say you rent an apartment, you pay $1,000 a month for your apartment. 1/3 of that space you use as a daycare center for a business that you run. At night, you use that space to watch TV and have your dinner. Totally fine, because there's that daycare exception. So if you use 1/3 of your space for the daycare, you can deduct 1/3 of your rent on that apartment. So the answer is yes, that's deductible, whether you own it or you rent it, either way. Let's see. Okay, I think that's our main questions. Let me just see. Oh, let's see. Somebody said if you have a full-time job and you travel to Long Island, and after first job workplace travels to real estate showing, how do you calculate on miles deduction? All right. So the rule about mileage between jobs is the IRS assumes that we're all responsible for commuting to our regular job. Like, you know, if I have a day job and it's a 10-mile commute, that's my problem. But if I own a business, or if I have 2 jobs and I have to drive between the jobs, that driving between jobs is a deductible expense. And driving to a real estate showing, that sounds deductible to me. Like, you know, if the real estate showing, I'm not quite sure. So one really important issue, remember, if you're self-employed, business expenses are deductible. If you are not self-employed right now, they are not deductible. So for this person who asked, if you have a self-employed real estate business, then yes, driving to your showings is a deductible expense. If you have a day job, you know, where you get a W-2, then no driving to outside stuff is deductible. So if you are a W-2 employee and your employer requires you to drive around for stuff, make them pay for your gas. Make sure they understand, hey, I can't deduct this. You know, you're paying me, I'm using my car for my job. You need to pay me for use of my car because there's no tax break for it. So again, that's the key difference is, are you self-employed or not self-employed? If you are self-employed, yes, deduct your mileage to real estate showings, deduct your mileage to wherever you're going that's business related. Somebody asked, gifts to clients, are there limits after you give a gift to a buyer or seller? The answer is yes, and I didn't double check the amount. I think it might be $25 per person that you can give as a gift. I would again Google that at the IRS, like, you know, say IRS client gifts or something like that, and Google it. I think it's a value of $25 or less. It's not a problem, and you don't have to report it. Oh, good. Somebody chimes in and says, yeah, it's 25. Okay. Somebody says, I own a brokerage and deduct that. Can I also deduct my home office? Hello, Mr. or Ms. Anonymous. If you are self-employed, you can deduct your home office. Now, I think this question might be referring to the fact that this person has an office and a home office. The answer in that case is probably. Let's see, I have some notes. Basically, kind of, can I deduct 2 spaces? And I think I had a specific note about that. So I'm looking for it now. Oh, by the way, publication, I said I didn't memorize all the numbers of publications, but here's one I noticed. If you have questions about business use of your home, like this one, check publication 587. It has all the complicated rules about deducting your home office. Let's see. So the issue that this person, if I'm understanding it correctly, the issue is maybe I have a business office and a home office. Can I deduct both? And I think the answer is sometimes. So it says it must be, so to deduct your home office, it must be your principal place of business. So if you conduct business at a location outside of your home, like your brokerage office, and you also use your home substantially and regularly to conduct your business, you may qualify for home office deduction. In other words, the answer is probably, but look at the specifics of your situation and see if you can find reference to it in publication 587. Somebody says, how about a bottle of wine at a closing day, an open house, cookies? I would say the bottle of wine that you give to your client, I would say that's a gift to your client. So I try to keep that under the $25 rule. Serving cookies at an open house, I don't think that's so much a gift. I would probably call that like just a promotional expense. It's an ordinary part of doing business in your business. By the way, in general about business expenses, the way you know if a business expense is deductible in general, besides these specific categories we talked about, is it usual and customary in your business, and is it reasonable? So in your business, I've been to plenty of open houses myself. Yeah, they all serve cookies. Everybody does it. It's a normal way to do realtor business. So it's deductible and it's reasonable. If you start sending away, you know, to serve $1 million cookies at your house, you're opening, which no one has ever done, then no, it's not reasonable. But if you're buying cookies like everybody else at a reasonable price, that's a normal promotional part, definitely deduct that. You're not eating the cookies yourself, you're serving them to clients. Somebody says to deduct a home office, does it have to be a specific size? Nope. As long as you're telling the truth, whatever size. You know, maybe you have 1,000 square foot space and you work in 10% of that. Then you deduct $100 worth of that, or 10% of your space. Or maybe you live in a 1,000 square foot apartment, but half of it is your home office and you only use it for office stuff. Fine, deduct 50% of your rent or your mortgage. As long as you're telling the truth, the size is not an issue. Okay, I think that's the end of our questions, and we've gone a little over time. So again, thank you, Marianne. Thank you, all you attendees.
Thank you so very much. I don't think I've ever seen this many questions.
Okay.
So we definitely need to have you back. Thank you so very much, Heather.
Thank you.
Have a good day. We'll be in touch.
Okay.
Bye, everyone.